Looking ahead to Jackson Hole, a couple of months away. Let's bring in Clear Harbour's Aaron Kennan. Jim Bianco of Bianco Research with us as well. And Jim, I think we've got to start with the bond market. Your 10-year yield at 160, up 2-3 basis points on the session. In the face of this conversation that's playing out right before us, in the face of a conversation about deficits north of $1 trillion for the foreseeable future, what are we doing down here at 160?
Oh, I think the market is just kind of staging for another move higher in rates. Look, we were at 50 basis points a year ago. It's been a generation since we've seen inflation. If you're under the age of maybe 60, you don't remember what inflation was. And don't forget that the first quarter was the worst total return quarter for the bond market in 40 years. So I'm not surprised that we're doing a little bit of congestion here. And I agree with your implication that rates should be going higher with these giant deficits, with all the stimulus that's coming. Patience, grasshopper, they will be going higher.
Aaron Kennan, do we need patience?
Well, you know, we haven't moved since March 31st. The average 10-year Treasury yield's 161. And that's almost exactly where we are this morning. I think the market is trying to figure out what the Fed's going to do, but the Fed is also peering ahead, John, and looking at the economic forecast for 2022 and 2023. And the reality is we're going to see robust growth this year, call it 6.5%. Next year, it's going to probably have a 4 handle on it. And the year after that, it's probably going to move back towards the secular growth of call it 2%. And I think that's the real debate right now that the market should be having. How does the Fed not only taper, but raise rates in 2023 and beyond in the midst of a significant decline in economic activity?
This is an important transition. We're going to decelerate, Jim, into next year, maybe a 4 handle in Aaron's mind, and from there maybe down towards 2. For the bond market, how do you think we need to digest that?
Well, I think the bond market needs to kind of figure out where stimulus is going to come from here. Yes, we've stimulated the economy to a 6 handle. Let's say we don't get inflation. I think the calls that we're going to ratchet up more stimulus in 22 and 23 will grow much larger, and we'll probably see some stimulus in 22, 23, absence any kind of impediment like inflation. So it's still very uncertain which way the economy is going to go. Now, yes, I agree. If we get no more stimulus, we're going to see 4 and then 2. But that's a big assumption that there's going to be no more stimulus coming after this year.
Well, here's the reporting from the news. We go through some of these headlines. I want to bring in Aaron Kennan and Jim Bianco. Aaron, it's a theme of this program over the last couple of weeks. What to expect down in D.C., how to establish a base case. At the start of the year, it was more. It was even more after Georgia. What is it now?
Well, Jonathan, after the August recess, we're going to be moving into the election season. And I think we all know that it's challenging to move anything through Congress during that cycle. So it's sort of now or never. I do think the focus on roads, bridges, and 5G makes sense from an economic perspective. I think the one hope for economic growth moving above that 2% trend level, like we had mentioned earlier in the conversation, is productivity. And if we can increase productivity, that's great. But on the other side, as Mike just pointed out, we have rising debt to GDP. That's a headwind to secular long-term growth trends. And we have an aging worker population and a deceleration in the overall population. So there are some real headwinds, but productivity in the intersection of that with the infrastructure bill is a sign of hope.
Aaron, traditionally, everything you had just described previous to what you just said at the end there is bullish for bonds. Does that change?
Well, you know, I just go back to, you know, what I think, where I think monetary policy should be is irrelevant. What I believe is looking at the dial of fixed income, which is 2 years are at 14, 15 basis points and 10s are at 160. And what is that telling us? It's telling us the curve's steep. It's getting steeper. The economic picture is strong right now. As curve flattens, perhaps in 2023, it means economic activity is going to decelerate. But in the front end of the curve, nothing has been moving for many, many weeks, if not months. And that's telling us the Fed's going to remain on hold because they're mindful that future economic trends are not going to be the sort of robust picture that we're looking at today.
Jim Bianco, what's your take?
I think it really comes down to the inflation outlook right now and whether or not we're going to see more inflation or not see more inflation. I believe that we are going to see more inflation. I think a lot of the indicators, whether it's commodity prices or even the strengthening yuan, are telling you that inflation is coming. It's here now, or maybe it's better described as it's not going to recede as much as everybody thinks, and that the narrative will change in the second half of the year towards getting away from the word transitory, and that all this kind of conventional wisdom that the Fed is going to announce a change at Jackson Hole and a...
Aaron Cannon back with us. Jim Bianco of Bianco Research with us as well. Jim, you know the trade, you're familiar with it, the cyclical trade, the commodity story, all of the above, energy, etc. How important a piece of the puzzle is the negotiations around infrastructure to make sure that plays out into year end and beyond?
Oh, I think it is important. I mean, just what Emily just said, look, we're at $1 trillion floor right now. We're talking about going higher. That's a lot more stimulus. That's a lot more money that's going to be used to buy commodities. That's going to be to buy finished products. That is going to put, I think, upward pressure not only on prices, but also on the economy too, and eventually on interest rates. So that's why you see the bond market react to these kind of budget negotiations more than they have in previous years, because these numbers are so big and they are impacting the growth outlook and the assumptions that everybody uses when trying to gauge the fair value of interest rates.
So, Aaron, is this another reason to stick with the cyclical trade?
Yes, it's one reason. I think the larger is the reopening story. I mean, we've had it here in the U.S. It's quite robust. There's a delay in Europe. Now we're seeing really nice growth coming out of Europe. European equities have responded to that, forward-looking, discounting forward-looking. Projections there in Europe look very strong. Global growth for next year looks very strong. Southeast Asian growth looks strong. I think that's the cyclical story. I don't think $1 trillion infrastructure bill is the big story for the cyclical story. I think if you believe the cyclical story is going to continue, you have to believe that global demand is going to be extraordinarily robust over the next year or two.
Aaron, the key variable in what happens here in the U.S. economy is what happens with that pile of savings, that savings rate. We know how much is sitting there. The unknown, Aaron, is how it gets spent, the degree to which it gets spent and where it gets spent. Do you have any idea of what that looks like from here through year end into 22?
Well, we just saw some really interesting earnings coming out of, sort of the retail sector over the last 24 to 48 hours. Very strong numbers. And so I think that's the trend line. There's been a lot of noise because, of course, we had the unemployment bonuses that still haven't really dissipated yet. So there's been a lot of noise in the employment data, as we have all seen. But I think the general trend is very positive there. You know, some children are still not back at school. Mothers and fathers have had to stay home. A lot of noise in that data, but I think that's going to sort itself out in the quarters ahead.
Jim Bianco, this is the challenge that economists have got right now. We know what the savings rate is. We know how much money is sitting there. We've got a rough idea. We just don't know how much of that's going to get spent.
Yeah, that's right. And it really, I think, comes down to a lot of confidence. You're right. The savings rate is at 22% right now, and it's considered to be a number that was inconceivable just 2 years ago to see it that high. But we are starting to see signs, as Aaron pointed out, that it is getting spent in a lot of ways and in a lot of different places. And one of them might also be in the labor market, too. I think a lot of the big miss in the employment report last month was because workers want higher wages to come back to work. They've got enough money right now that they can just sit around and wait for that. And companies are starting to respond by raising wages. So we could see a specter of wage inflation on top of everything, too. But to your point, that savings rate and what happens with it is going to be a big issue. Right now, a lot of it's in the stock market, and we'll have to see how much of that actually comes out of the stock market as people get confidence and start spending it.
The next couple of months is going to be absolutely fascinating. Aaron Cannon, just a final word from you. Final question. Conviction trade going deeper into summer. What is it now?
Oh, gosh, that's a great question. You know, I think we look at the forward, estimates for earnings. We are, quite positive on that. But, for us, it's about 19 times. So we think, the market's not extraordinarily expensive here in the U.S. We think the European equity trends look quite positive, and we think, we want to be a little more shy on China, but certainly non-China EM looks quite interesting, where longer-term growth trends there will most likely continue and start to outpace the U.S. and developed world, which hasn't happened over the last couple of quarters. So that's certainly one trend that we're keeping our eye on.
Aaron Cannon, appreciate your time, as always, alongside Jim Bianco. And Aaron, happy birthday, too. I understand you are the birthday boy today. So happy birthday, sir, and thanks for spending some of it with us. Thank you. Equity futures up 0.2%.